Welcome back. You're watching The Money Show on ET now, and we thought that with just about a month and a half to go for you guys to make your tax-saving related investments, what better than to speak about the Kotak Tax Saver Fund, which, as the name suggests, is valid as an ELSS fund under Section 80C. Here are some of the interesting parameters of the Kotak Tax Saver Fund. Some of the top holdings are from the banking space. ICICI, HDFC, even a Reliance Industries, by the way, features prominently. And then you do have a moderately high riskometer. So let's now bring on board the fund manager, Mr. Harsha Upadhyaya, to talk a bit about this fund. Harsha, thank you so much for joining us on The Money Show. Like I said, at this point of time, a lot of viewers are looking out for tax-saving investment avenues now that we're approaching March. So why don't you start off by introducing the Kotak Tax Saver Fund to our viewers?
Yeah, the Kotak Tax Saver Fund is a fund which is an equity-linked savings scheme. It gives you growth potential by investing into equities of various businesses, and also gives you tax-saving benefits. And any investment made in this particular scheme up to 1.5 lakh rupees in a single financial year, is exempt from tax under 80C. So that's the benefit that you will get by investing in a tax saver fund. And also, just like any other equity diversified fund, this will have a multi-cap diversified portfolio, which will also enable you to earn more than some of the comparable tax saving avenues that are available in the market today, with a lesser lock-in, because most of the other 80C products have a higher lock-in of anywhere between 5 years to 15 years. But in case of tax saver fund, the lock-in is just about 3 years.
Okay. Now, interestingly, Harsha, your fund has managed to return quite an alpha, especially in the last 1 year when markets were struggling. So what's the secret sauce? What's enabled you to deliver that?
Yes, on a 1 year basis, the fund has delivered nearly 500 basis points of outperformance against the benchmark. And clearly that has been achieved by taking right calls on sectors, as well as some good stock selection. We were underweight on some of the consumption sectors such as auto, consumer durables, even before the demand setup started to weaken. And also we were out of the NBFC segment, given that the margin of safety was less in that particular basket. If you remember, both of these segments clearly underperformed during 2019, and we had very less position in these two segments. And also some of the changes that we made to the portfolio during the year, for example, increasing our tilt towards mid and small cap a little bit as compared to where we were in 2018, also helped us, because the valuations were very attractive in the mid and small cap basket. And over the last quarter of 2019, that basket again has outperformed the benchmark, and that benefit also was gained by Kotak Tax Saver. So I would say that the prudent and disciplined investments that we have been doing over a period of time, focusing on fundamentals and not taking any event or tactical bets, have helped the fund to deliver outperformance against the benchmark.
Harsh, how do you ensure that only the good quality companies enter the fund, especially since we've been seeing so many cases of defaults, etc.? What's the filter or screening process?
Depend upon our in-house research for our investment ideas. It's a stable investment team that we have been blessed with, and that's what we depend on. We do our research on a rigorous basis on all of the portfolio companies and the potential companies on a regular basis. We focus on three things: for example, business, management, and valuation. And these are the three elements that we focus on and try to find way to bet. And also, as a policy, we do not really take tactical bets in our portfolio or event-based bets on companies. So our investment process is mostly growth at reasonable price, and it is fundamentally driven. And we rely a lot on our in-house research. And these are some of the things that have enabled us to really perform on a consistent basis in the past.
Quite overweight the industrials manufacturing space relative to the benchmark. What makes you optimistic on a space like that?
Clearly, the non-consumption sector, and within the non-consumption sector, I would say engineering, cap goods, cement, etc., have been in terms of valuations have been quoting at one of the attractive levels that we have seen in the historical past. And also we believe that there is visibility of 1 to 1.5 years in terms of earnings growth in this basket. And we believe that to kickstart economy, government will actually go and invest further in infrastructure activities, which will enable further business for some of these companies. And also we believe that these are the companies which are less leveraged compared to many of the other segments of the infrastructure activity. So to that extent, there is less leverage, there is reasonable degree of visibility on short-term earnings, and going forward we expect government policy push to enable further order inflows. All of this put together, and the fact that on a valuation basis there is a lot of margin of safety, this is what has made us to bet on engineering, cap goods, cement, some of these sectors.
What sort of return expectations then should unit holders have from the fund from here on, especially after you've had such a great year?
In terms of return expectation, I think it would be similar to the equity category that the diversified equity categories would deliver. I would say that any investor who is coming here is anyways coming with a 3-year lock-in, and in a 3-year time frame, usually you would have seen ups and downs in the market. The businesses would have seen that, and on a sustainable basis, one can expect something similar to what has been delivered in the past in terms of long-term returns. And added to that, in Kotak Tax Saver, you will also get the benefit of ATC benefit, which is up to 1.5 lakh rupees for the year.
All right. And what's the risk profile of this fund?
This is good for all regular investors in equity, although from a SEBI classification perspective, it shows as moderately high. But I think almost all of the regular investors in equity can invest into this fund. And also we would suggest, rather than waiting for the end of the season to invest, one should have a systematic investment plan running all through the year, so that the volatility that is there through the year will also be used for making investments, and one can have a systematic investment plan going, which will enable them to buy units at a lower cost if there is downside volatility as well. And over a period of time, the empirical evidence has shown that usually it beats volatility and also enables them to earn slightly better than lump sum investments.
Well, that's a very important piece of advice. An SIP wins any day. Don't wait till the last week of March to subscribe to the fund, the tax saving fund. Okay, thank you, Harsha, for that. With that, we'll wrap it up on this edition of The Money Show. Many thanks for watching.